We're now moving to the next part, which is vertical and horizontal analysis. We do it for balance sheets. We do it for income statement. The idea is very similar, but I will emphasize the importance and what do we really learn and what is really can help us. So let's start with the balance sheet. Okay, first of all, you have a recording already. Okay, by the way, whoever speaks Arabic, you can transfer to Arabic and you will be able to hear. I don't know if I showed you last time, but this one is
English
already
would be
working.
much easier still.
It is already working. This is the 9 things. He just finished the first part that I was talking about. He finished in Arabic. So now we're working on the French. It's about time. Okay, good. So it's the English. Good. Let's go back. What happened? Did I log out by the mistake? I'm going to the balance sheet. I won't go and read those stuff. I will just jump right into the analysis and I leave it to you to read. It's really nice and explaining really the purpose on everything, but I will speak really about those. So we have the balance sheet. Why do we really need vertical or horizontal analysis? Let's start with the vertical. Vertical means that I want to compare the balance sheet of a company for 1 year to another year. How would I do it? You know, the company might be growing a lot and then it might look like very different company. So I would like to see if proportionately any account got bigger than other accounts. One more time. I would like to compare the balance sheets of 1 year to another year. So let's say 2001 to 2005, okay? I see the numbers going up, but just by seeing that all the numbers going up, I can't really say which account have grown more than other accounts, okay? So that's why we will standardize the balance sheets. So vertical analysis is standardizing the numbers in the balance sheet. That's one useful, and we'll see in a minute. A second thing, how about if I'm trying to compare my company to another company? Maybe my company is 10 times bigger, but still that we are in the same industry. Can I say something about a specific company compared to the whole industry? So if I just take the numbers as they are, I won't be able to compare companies in different sizes. So if I want to bring them to the same footing or the same benchmark, okay, I have to really standardize all of them. That's one of the reasons why vertical analysis many times being called common size analysis. It's a synonym word to vertical analysis. You standardize all of them. What is the standardization process? Very simple. I take the total assets and turn it to 100%. So in this year, I have 810 total equity and liability of the total asset. Those numbers has to match. So how do I convert those two numbers? Very simple. They become to be 100%. So here I have 100% and here I have 100%. Some things I do for all the years. So for me, every total assets become to be 100%. So the 1151 is 100% of total assets. Okay, so that's the benchmark number we compare all the other numbers to. What do I mean by that? If this is 100%, I want to check how much is the total liability, long-term liabilities is. So I take 780 divided by 810. That will give me a percentage. And that percentage, I will show here in the comment. So if I look at the total long-term assets, it's 96.3%. How did I get that number? I took the total long-term liabilities and divided it by the total assets. So if I take, hold a second, did I mix it up? Long-term liabilities, I have this 96, it's simply the total long-term liabilities, which is 600, okay, divided by the total assets. That is what it's supposed to be, okay? Now, the long-term, my mistake, I apologize. Long-term assets, it's 780 divided by 810. That's exactly 96.3%. That's the way we do it, okay? Now, if I look at total current assets, it's 30. It's 30 out of 810. 30 divided by 810, it's exactly 3.7%. So 3.7% equal 30 divided by 810. We do the same things for all the other years. So if 30, it's 3.7% out of 810, let's see what happened in 2005. 2005, we have more current assets, but is it higher also percentage-wise? So let's see, 101 divided by 1141, that becomes to be 8.85%. What do we learn from that? So not only did the cash have gone up, it's went up proportionately more than the other current assets. One more time. I see the cash going up every year for this company, but I do see also the current asset going up. Can I say something about, is the cash going up faster than the current asset, the other current assets, not including cash? And how do I know that it did go up by a faster rate, let's say, or lower rate? Simply, I will look at the cash used to be 0.99, less than 1% out of the total assets. Now I see that it becomes to be 5.7. It's almost 5.7 times than it was before. Current assets was 3.7%. Now it becomes to be 8.85. It's about less than, it's about 2.5 times. So this one grew up by almost 6 times. This one grew up by 2.5 times. So no question that the cash is going faster than any other current assets. Moreover, by seeing that this one is growing by 5.7, and I look at the total assets, they are the benchmark. So proportionately, the current assets have grown up out of proportion. It should be, if it was the same proportion, it should be this number, all of those numbers should have been 0.99, because how do I get those numbers? I can't divide them by the total assets. So what do I see here? Total asset is going up, but the cash is growing much faster, because I normalized. The total asset began to be 100%. Therefore, if the number here is higher than the number here, that means that the cash is growing much faster than the total assets. And that's one question you ask yourself. Why the cash is going up? What's the reason? Mismanagement of the cash? Probably I will call my CFO and I say, hey, guy, you have a lot of cash. Why don't you maybe invest it in commercial papers? At least get some interest on it. Why don't you advise or distribute more dividend? Okay, if we're not using this cash, why should we keep it? So that's one thing that vertical analysis can help to highlight. If I see numbers that going up in the vertical analysis, anything that the number is going up, that means proportionately it is growing faster than the total assets. That's really what it means. When I say here 5.7, I say here about 1, that means that the current assets grew up 6 times faster than the total assets. Okay? Now, I could have done, and that could be a really nice exercise, when you look at your company, not just look at the vertical analysis of the company, you can take the same like a representative balance sheets, normalized balance sheets of the total industry. Why is that important? Because by looking at that, I know that there's a change in the amount of cash I'm holding, but I don't really know what is it supposed to be. These numbers don't tell me how much cash a company like that should have. Depends on the industry. Some industry require to hold more cash, especially financial institutions, okay? They will have to hold more cash to be available. The liquidity will be very important. We'll see it when we get to the ratio analysis. But I can't really tell is 5.7 is the right number or 0.99 is the right number. To really know what the right number is supposed to be here, I really need a benchmark here, which is the industry, okay? So in your paper, try to get the ratios for the industry, or at least take 2 or 3 other companies, or one at least, other company and compare it to it. And that's what give you a good benchmark, what the cash is supposed to be. Just the cash is not only the cash, it's true for every other account. Let's take another account. How about property, plant, and equipment? That's really the main asset. We see it is quite stable. They had 49% out of the total assets. They have 43. Might be justified, okay? Maybe I have efficiency and I can utilize the assets better and I don't really need the same amount in investment. And the difference is not that huge. I see here a decline a little bit, but it might be just a normal business. We'll get to that point in a second. But anybody see here number that changed drastically? Anybody? From all those numbers here, do you see any number that changes drastically? And what does it mean? How about liabilities? Anybody see something with the liabilities?
Liability is reducing.
Oh, beautiful. And if you want to say the complete sentence, you're absolutely right. You see the liabilities is going down relative to the increase in the assets. You know, the total assets is going up. And I still see a declining in the percentage. Maybe the liability goes up. Could be a case that you will see those numbers going down and still the liability goes up if the assets just blow, if you have a lot of increase in the assets. So you can say, what I can say about the story of this company. I can say when the company in his beginning, 74% were financed by long-term liabilities and only about 21% or 22% were financed by equity. On the other hand, only 5 years later, most of the finance became to be by equity. Almost 77% financed by equity and only 23% financed by debt. That's a very interesting. Hey, that's very interesting. This company, from being so leveraged, if you remember the concept, I don't know if you had it in the accounting, a company with high debt, we call it very leveraged. Leverage we were seeing the ratio analysis, is the ratio of debt to equity. See, the debt to equity here, I have 78%, 74, we look only at the long term, 74% relative to only 21%. It's almost 3 times, more than 3 times. So it's a really high leverage, high ratio of debt to equity. On the other hand, 5 years later, it's only about 17.5% out of the, it becomes to be less than a third. It's about less than a third really, less than a quarter, you know? So this is a company that used to be really leveraged, turned out to be very unleveraged. Very interesting. What other things you would like to check, understanding the change in this structure of this company? Anybody? What might be the source of that change?
Excuse me.
Yeah.
I have one for the, you mentioned that's increase in the equity, but it's more more on the retained earnings. So
beautiful. That's what I was looking. Very good. Very good observation. Excellent observation. You know, the equity went up to 76, but pay attention, very interesting. The common stock, you know, if the company is going and you didn't change it, it will go down slightly. That makes sense. But we see here, you're absolutely right, a huge increase in retained earning. Continue, or anybody wants to help out. It's a beautiful observation. The increase of the equity, the source of the increase, it is retained earning. And what caused retained earning to grow?
It's maybe like because the debt is decreased, so it means that the company's the revenues, the cost is increased, so they pay the debt, and they don't have to pay the interest. So the interest is go down. So just one of the
you have said it before correctly. What is increasing retained earning? Let me open again another screen. Okay, we'll look at the balance sheets. We'll get the same. You said that correctly. I will just re-say it. Okay, if we look at our previous session, and we said that what is the cause that retained earning is growing? How is that growth come about? And you said correctly, you have more, you said revenue, but you probably meant the net income. And the company have a lot of earning maybe, and they don't distribute the whole things. So they have, on one hand, a lot of revenue, and they don't distribute a lot of dividend. That really could explain why we see here an increase in the percentage of the retained earning. So let's look at the balance sheet. What really happened to the retained earning? You're absolutely right. You see 128 went up 180. We only explored those 2 years before. Wow, look at that. A big jump, big jump, big jump. Look at the common stock, no change. Now let's add them together. The company made a, can I say that story? Tell me if it's true, if anyone want to jump. This company seems to me making a lot of profit and not distributing a lot of dividend. They are not raising any money, additional money, only the first year, they raised 15 as common equity. Later on, they didn't raise any money from the equity owners. I see 65, 65, 65, 65. Now, this constant number makes sense that why this number is going down slightly. Why they're going down? Anybody want to guess? If this is 65, why is the numbers here going down? Anybody want to guess?
The total equity is...
Why? Because?
The total equity growing, so...
The total asset is going up. If the total assets going up, say 65 divided by 816, it is a higher number than 65 divided by 1141. So if I'm not raising any money, my total assets going up, so the percentage of the amount of money I raised as issuing common stock, the percentage-wise, it goes down. 65 divided by higher numbers will be a lower number. And that's exactly what we see here. That number is going down. That's beautiful. But really what's striking, it's this change. Retained earning going wild. Retained earning going wild. What the source of retained earning? If we look at what we learned last time, it's the net income. Net income minus dividend goes right into the retained earning. The increase in retained earning, it's increase in revenue, which translated to net income. But we do not distribute it as a dividend. So if I were to ask, what is the dividend policy of this company? You can say probably moderate, in the sense that they're making profit and they are definitely not distributing the whole things. As you can say. Moreover, if I were to ask, what are they doing with all this profit?
They're not investing it.
Exactly. So what they are doing, beautiful.
Sitting on a lot of dollars.
Hold a second, I like that comment. Beautiful comment. How do you know? You're absolutely right. We said it before. You see, we see property, plant, and equipment, it's even slightly going down. But it's slightly, I can say, that's fine. The total assets, it's the main part. They said, so what are they doing with all that money?
Sitting on it.
No. Look at that. What is the other number you're looking at? Okay, we talked about the assets. We talked about this part. What is left? How about that one? What happened to the liabilities? Anybody can say?
They're reducing the debt.
Very good. Look, they used to have 74%. They have only about 17.5%. Let's look at the balance sheet itself.
But
a lot of debt. They are paying the debt with the profit they're making. That's beautiful. Now, if I were to ask you, let's jump. I will jump and come back. I will open one more. Why not? We can open as many as we want. Then we can jump from one to another. What do you expect to happen in the income statement? How would you translate? How do you translate the fact that the long-term liability is going down? Which number should attract your attention immediately in the income statement? Let me open it up.
The interest expense.
Beautiful, beautiful. So if I'm reading, let me jump to the net income. I just jumped to the next one, okay? I'll go back to that. Okay, let's look at, somebody said correctly that the interest expense should go down. Is that correct? Look at that, I have 120, then it went up a little bit, down, down, down. That makes sense, doesn't it? Because I have less debt. Less debt, I pay less interest. And the beautiful part of it, by the interest going down, my profit will go up. No surprise, look at it. That goes right nicely with our story. Retained earning going up because net income is going up. And I'm not distributing the whole things. Okay? So if I were to give you an exercise, how much dividend they have distributed in 2005, will you be able to find it? My answer is that yes. How much net profit was in 2005? 705. Is that right? Let's go back to the balance sheet. What happened to the retained earning from this year to this year? Let's take a note here. That's just another one. I'm just trying to get you used to and not get scared from those numbers. They become to be really easy. Okay, how much was retained earning in 2005? 877. Is that right?
Yeah.
How much was it in the beginning of the year or last year? 791.
791.
What is that difference? Anybody want to tell me? That's it. That will be 6.
86.
That will be 8. 86. What? How do we call that number? What is this 86? And how do we relate it to the what we just saw here?
Increase in cash.
We have 705. That's the net profit. Tell me the whole story. Somebody was saying something. Go ahead. There's no error. Don't be afraid. Whatever.
But
That's fine.
go to pay your tax, pay the tax more.
See, that's the profit they made. That's net income. That's the change. Oh, sorry. Change in retained earning. So how do we put those two together and find the dividend? My goal is to find the dividend. How much was the dividend? Anybody? Don't be worried. You can be wrong. That's fine. That's why we have a class. What do we do with the net income? We can do only two things. If we don't pay any dividend, if we didn't pay any dividend, how much should have been the change in retained earning? If I didn't distribute any dividend, how much should have been the change in retained earning? The change in retained earning has to be net income. So if I see that if I see that my retained earning went up by 86, that means the difference must be the dividend. So I will do, that will be 9, 1, and 6. That's the amount of dividend I paid. See, retained earning was 791. I need to add to the 791 the whole amount 705. That will be a much higher number than 877. The difference will be exactly the dividend. You can do it another way. You can go this way. You can say, okay, retained earning was 791. I will add to that 705. That will be net income. That's retained earning. Last year, previous year, I will add those two. That should be how much it should have been if I didn't distribute any dividend. But since I distributed dividend, I will leave it blank. After distributing the dividend, how much I have retained earning? My retained earning, it's 877. 877. So I need a plug-in number here. And the plug-in number would be very simple, the difference between this one and this one. which will give you exactly the same number as 619. Should be 619. Fair enough? Same things, same story, just slightly different. Okay, I have retained earning. I am adding to it the net income. That's the amount of returning should have been if we didn't distribute any dividend. Since we distributed some dividend, that's the balance of retained earning. So I can really work it out backward. I know this number, I know this number, I can find the difference. Another way to do it, I can look at the net income. I see the difference in retained earning, that minus that, it's exactly the same things, no difference. So here we have a beautiful company. On one hand, they're making a lot of profit. Secondly, they're distributing dividend, growing up amount of dividend. Third, okay, they're paying the debt, reducing their interest payment. The net income is growing, and then they're also, in addition, distributing a lot of dividend. That's beautiful company. I wish all companies were like that. Okay, but this is really, you can really get it from the numbers. Now that we know how to read them, this one, please go over it one more time or even 3 times more and repeat it.
Excuse me.
Go ahead.
You said that it's a beautiful company, but if we look another point of view, such for investment in the future, is it good thing to do?
Well, excellent question. The question is, should we keep, first of all, should we keep more cash or distribute the cash as a dividend? And if we're keeping the dividend, the part of the profit, what should we do with it? So that's really a very important question. I give you an example. Look at Microsoft. When Microsoft was established, their first 15 years, they haven't distributed any dividend. Google have announced about 2 years ago that the following 15 years, they are not going to distribute any dividend. Now you ask yourself, I have a company declaring they're not going to distribute any dividend for the next 15 years. Why their stock price goes up? And we know they went up substantially. Google, Amazon, all of those have very similar policy. I will extend the discussion a little bit even more to make my point. I will say one more thing that Google is doing and will be amazing. Then you ask yourself why people buying their stock at all. But just for now, why Google have decided, or Amazon have decided not to distribute a lot of dividend? Very little. Think about it that way. People give money to Amazon to use it and develop a business. If it's very successful, I would like my money to stay there, not to get as a dividend, because the money in Amazon is growing faster than I can get it in another place. Therefore, I like the company not to distribute dividend. Or another word, as a general statement, if a company have a prospect to grow and make return on my money, which is high, I would like them not to distribute dividend. On the other hand, when a company achieving to a steady state stage, what do I mean by that? A stage that they are already big enough, it's very hard for them to find big investment that can give a high return. At that moment, a company has to start thinking about their dividend policy. At that point, you would like the company to start distributing dividend. Some companies, even when they reach that stage, many times they have a policy of giving the same percentage every year. Meaning they're saying, well, we arrived to a stability, not only a mere stability, but we have a really stable stability. Meaning that we are sure we're going to generate the same profit every year. We're not sure that we'll make a higher return, but we can keep the same return. Okay, and now by distributing the same dividend every year, proportionately to the value of the shares, they're kind of sending a signal. We are a stable company, we reached maturity, and we're going to keep going the same way. Okay? In this case, we see a company that maybe for some reason, the beginning, nobody trusts them. They had to finance it in debt because nobody wanted to give them almost any equity. It's a very low equity, only 50. They got a big loan, started the business. They proved themselves to be good. They raised slightly more money, but not really substantial. And they're even telling the market, listen, we already, after a couple of years, we start paying back the debt. Look at our balance sheets. Look at that, okay? The first 2 years, we are only startup. We still have solid profit. And then look at that, we have a big jump. Now, I would like somebody to jump and say something about this jump in the net profit. What another thing should attract your attention in the balance sheet? Really hard to see it right away, but in a minute later on, next time more correctly, we'll talk about horizontal analysis. But even I'm directing you, look at the balance sheet, the income statement. What do you see here in the top part? Do you see any exceptional year in those 3 years?
2013.
2003, correct. What do we see in 2003?
That the cost of goods sold is significantly lower than every other year.
Beautiful. What else do you see it's lower than any other year?
I mean, let's see.
What about the revenue?
It's,
The
yeah,
revenue is lower.
Exactly. In fact, I should have done 2003, I should have put 2008, like a collapse in the revenue. But you have said something.
Or 2020, it's also an option.
Exactly, you can set 2020, but we don't have the financial statements yet. Next year we will know it. We'll see that. You're absolutely right, next year. But what is beautiful about this company, we talk about next year, next time, but I'm heading, when we talk about, let's look at the vertical analysis, you'll see something very interesting. First of all, we see a decline, and you said correctly, a huge decline as well. So let's look at their vertical analysis. Since I'm turning the revenue to 100%, look at the cost of goods sold. We see a decline, not only a decline, also as proportion to the decline in the revenue, the cost of goods sold have went down even further. Because last year, I had a high revenue, but I had also a high cost of goods sold. Cost of goods sold was 77% almost from total revenue. This year, it was a really tough year. My revenue went down, but also I was so efficient in handling the crisis that I reduced my cost of goods sold in such a good way that I made even a profit. Look at that. Last year, my profit was 21%. This year, out of the revenue, it's even went up. This is an excellent management, isn't it? Even a year of a crisis in which the revenue goes down, I'm reshuffling my forces, reshuffling my business, and reducing the cost, okay? Taking it into my advantage. Maybe it's international crisis. My revenue went down, but I negotiated with my supplier. They have to reduce the prices. Otherwise, I won't buy. So I really took advantage even the crisis. True that my revenue went down by 300, very substantial, but at the same time, I handled the cost very well. By handling the cost, my gross profit went up. from 450 to 600. Not only in amount, also percentage-wise. Now I'm making $33 out of $100. That's beautiful. That is a good management, okay? Moreover, another thing you can say, the story, what was the source of being able to do that? See, in here, it doesn't really seem immediately, but if you look sales and marketing, percentage-wise, it's higher. That means maybe they have kept, or maybe even the rest. In fact, they didn't. They raised it slightly, okay? And maybe one of the reasons they kept the sales and marketing just to make sure, okay, if they reduce it the same amount, then might be they wouldn't be able to sell anything. So sales and marketing percentage-wise went up slightly, you know. It's about the same or went up slightly relative to the following years. But that might be a really smart management that's saying, well, the world is in a crisis. We negotiated really good prices with suppliers, but we have to advertise. We have to do a good campaign. So we'll keep the cost a little higher. So if we negotiated very well this one, we're going to keep this one about the same, maybe slightly less. But we're not going to reduce that substantially. That might be a mistake. We would like to market and tell everybody we are in a business. Everybody can trust us. So that's why we're keeping the cost of marketing, sales and marketing. That's very important. That's when you can see that was high minus and that went down. The following year, they can allow themselves, okay? They reduce it slightly, but since the revenue went up, they didn't increase it the same way. That's good management, excellent management. Beautiful.
Amos,
Yeah.
it seems that they actually not negotiated better prices, perhaps some, but I think it's the process efficiency because you see it in the following years, they keep reducing the cost of goods.
You might be right. You might be right. I can't really tell from those numbers.
From 63.89.
You're probably
60.
right. This is really good. This is a good point. If they are, especially if you talk, see, if I talk about a retailer, then my previous story will hold. If I talk about manufacturing, your story definitely hold. And it could be a combination of the two, depending on the business. But that's a good point. Excellent. By the way, taking the analogy of standardizing the balance sheets, how do we standardize the income statement? We take the revenue to be as 100%. If in the balance sheets, we take the total assets to be the 100% every year, in the income statement, we take the revenue to be 100%. So each number here turned to be 100%. So let's see, how do I calculate the 58%? The 58%, it is exactly 1450 divided by 2500. That will give me 58. The same is about the rest. 70 divided by 2500 give me 2.8%. Okay? Again, why do we do that? We can compare one year to another year. Secondly, we might look at other companies in the industry. For example, if I see that everybody in the industry, gross profit, the gross profit, it's only 20%. What can we say about this company? If I tell you on average, over the years, and this year, most of the companies more or less making 20%. What can you say about this company?
That is in a much better situation. It doubled.
Beautiful. It's true here, you can say. There used to be normal company. Who knows what happened this year? Maybe it was a difficult year, but it was a turning point for this company. They become to be, and maybe the other guy that said before, he might be right. They become to be so efficient in production. And bingo, Look at that, 3 years in a row, more than 30%, almost 40% here. Much better than the average in the industry. This is a company I like. This is a company that shows big improvement. Gross profit is extremely important. It says manufacturing might be better, management of buying, dealing with suppliers, efficiency in handling customers, anything you can think about. Gross profit is extremely important number. You know, getting 40% depends on the industry, could be really good. And that's why we always compare to the industry. So that's why we use vertical analysis. By the way, you can see some story we can say about the net income. We started about 5 to 6%. We're ending up with almost 30%. Phenomenal. Everybody would love a company. You can see that in many startups, but not all of them. Many of them, you have no profit to a negative and then they close it up, okay? This is a good startup, I would say. Jumping to 30% net profit. This is really exceptional. I don't think there's many industries, if at all, that make 30% almost net profit as a percentage-wise. So that's really the analysis of what we call vertical. Let's go to the horizontal. That's always the balance sheet. If in the vertical, we looked at every year by itself, and then after we converted the number to percentage, we can compare. What we do in the horizontal, we compare 1 year to the previous year for every account. Let me take one example and then we dive in. How did I get the 125 and what does it mean? The 125 was calculated by taking this account, this amount, minus this amount, divided by this amount. Let me write it down. I take 18, which is the account, the balance of this account 2002 for cash. I subtract the amount of previous year. That's the change. And now I'm trying to calculate how much is it as a percentage relative to what the balance was last year. I divide it by 8. No surprise, it is more than 100%. You know, it's more than double, really. 125, it means it's more than double. If it was 100, that would be double. If it was going from 8 to 16, it would be 100% jump. But it was really, that means the balance in the cash, well, was more than 100%. From 8 to 18, it's 125. If I look at total assets, what do I have total assets? Anybody? Here we go. We have total asset change of 0.74%. How did I get that number, 0.74%? Very simple. Let's go into the total assets. Let's do the same things. We will do, how much is total assets this year? Total assets at 16. Minus, it was 810. That's the change. We divide it by how much it was last year. That's supposed to give me the 0.7. You see, it's a really small change. Total assets almost didn't change at all. So that's why I get it less than 1%. Here we go. That's equal, this one equal to 0.74. So now that we know, what can we say about the cash? What's happening every year to the cash? Is that going very fast? Anybody? What happened to the total assets? Let's look at the cash relative to the total assets. That's the cash every year. It's every year, it's almost more than, every year is almost more than 50%. That's really amazing. It's a lot. It's a big change. What happened to the total assets?
Increasing.
It's barely changed. This is a big change, but there's even little decline in total assets here. So bottom line, the total assets not really growing that much. Okay. Moreover, if the total asset is not growing too much, that means this increase of cash, too much cash, probably other things might not grow fast as the cash. And why? That's a question I will pose to the CFO, the Chief Financial Officer. What's going on? Your assets are not going up by much every year. On the other hand, why you are accumulating a lot of cash? And immediately will ask, if that's the case, why you are not distributing dividend. Moreover, the second question I will ask him, look at your inventory. You used to have 22%, you used to increase inventory by almost every year by 20, almost 30% even this year. Later on, you slowed down. Is the business is slowing down? That's why you're not increasing inventory? You stopped growing? Is that the reason why you're not increasing inventory? What's going on here? Secondly, I will ask, hold a second. You used to give a lot of, you gave a big credit here, a huge jump in the credit you're giving to customers. Let's look at it, 2002. 2002 account receivable. You used to have 1.11, you jumped to 1.35. Is the growth in revenue is the reason? The reason is because you're giving a lot of credit, and then later on you slow down, that's fine. Your credit is not changing, but there's a huge jump here. Is that means you changed the policy of credit and then you kept that stable? Is that really, that's one thing that I can translate. Why do I have an increase, a huge jump and the account receivable? If I have from this year to this year increase of 42%, maybe was boosting sales and giving credit to customers. Okay, it could be. Later on, it's really more or less stable. No change almost, very low, lower than 10%. That could be another explanation too. What other numbers might strike you immediately? What about property, plant, and equipment? Let's look at that one. What's happening every year? Here we have a decline, a little increase, 25%. But on average, total asset is almost stable. That means no real growth. No surprise, total asset didn't go up much. So if we want to summarize this company in the last minutes left, we're seeing a company that's making a lot of profit. They're probably doing something good, but they're probably distributing a lot of dividend. They're going up, they're distributing a lot of dividend, and they're paying debt instead of growing. One more time, and that's really the bottom line. We have a company that's making money, and they're using the money to really pay debt instead of growing. If they wouldn't pay the debt, they could have bought more assets. And that's a questionable policy. Is this a good idea or a bad idea? That's what we have to check based on the industry. And why should you have such a low level of debt if everybody else in the industry might have 60% debt? You shouldn't pay less than 20. Okay, we will continue next week. I will do a review as I usually do, always as I do on the previous session. And we'll take it from there. Hopefully next week we also will talk about also the ratio analysis. We'll start talking about ratio analysis. Everything is clear? You're doing good?
Yeah.
Yeah, so far.
So here is your homework for the week. A very hard homework. Everybody have to send me an email and say, hi, Amos, during the week. And you tell me you watch the video again and you review the session. Fair enough? That's the homework. But at least in the email, you must say, hi, how are you, Amos? Then you can extend, okay?
Okay.
Thank you, guys.
difficult.
Have a
Thank you,
wonderful
Amos. Have a great
Thank you, Amos.
weekend.
Yeah, have a great weekend.
Bye.
Have a good
Bye-bye.
weekend. Bye-bye.
Bye. Thank you.
Bye.
Thank you. Bye bye. Have a great
Thank you,
weekend.
guys. Have a good one.
Bye. Bye.
Bye.
Thank you. Bye bye.
Bye bye.